Welcome to the Riskwiser Zone, the podcast where we dive into the world of stocks and finance to help you make informed decisions about your investments. I'm your host, Louis, and I'll be guiding you through the latest news and trends that are shaping the market. Today, we're taking a closer look at the recent earnings reports from tech giant Meta Platforms. Incorporated, the company has been making waves with its artificial intelligence strategy, and investors are eager to see how this will impact their bottom line. According to recent reports, Meta's Q1 earnings beat estimates with a 16% year-over-year increase in sales, reaching $42.31 billion. Net income also saw a significant boost, coming in at $16.64 billion. But what's behind these numbers? Our analysis suggests that Meta's solid AI strategy is a key driver of this growth. The launch of the Llama-API and standalone Llama app, for example, is expected to enhance consumer engagement and AI monetization, positioning Meta well against competitors like ChatGPT. Additionally, the company's increased capital expenditure guidance to $64.72 billion defies the narrative of an AI capex slowdown, signaling a robust AI outlook for the year. We'll also be exploring the potential risks and challenges that Meta faces, including an economic slowdown impacting ad revenue and ongoing antitrust cases. However, with Wall Street targets suggesting a 29–50% upside potential in Meta stock, it's clear that investors are bullish about the company's prospects. As we delve deeper into the world of Meta and AI, we'll be examining the implications for investors and the broader market. Is this a sign of things to come for the tech industry as a whole? And what does it mean for your investment portfolio? We'll be discussing these questions and more in the coming segments with expert analysis and insights from our team of financial experts. So stay tuned for a comprehensive look at the latest developments in the world of stocks and finance. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. I'm your host, Louis, and we're glad you're joining us again for this middle segment of our show. Today, we're diving into the world of real estate and mortgage lending, with two fascinating stories that highlight the complexities and challenges of navigating the housing market. First off, let's take a look at a story from across the pond, where UK mortgage lending has reached a 4-year high in March, driven by a rush to avoid the stamp duty rise. According to Bank of England figures, mortgage borrowing surged by 290% in the weeks leading up to the April 1st deadline, with lenders experiencing a flurry of applications as home buyers sought to save thousands of pounds in stamp duty costs. Now, you might be thinking, Louis, this sounds like great news for the housing market. And indeed, it does indicate a certain level of activity and demand. However, experts are cautioning that the number of mortgage approvals for new purchases actually fell for the third consecutive month in March, which could be a sign of a slowdown on the horizon. As Rosie Hooper, a chartered financial planner at Quilter Cheviot, noted, this figure dropped by 800 to 64,300 in March, and given those looking to purchase a new home will have to contend with a significantly higher tax bill going forward, we can expect this decline to continue at pace for some time yet. So while the short-term surge in mortgage lending might be a boon for lenders, it's essential to consider the broader context and potential long-term implications. Meanwhile, on our side of the Atlantic, a thought-provoking article highlights the challenges many American households face when trying to tap into their home equity. The piece notes that despite amassing $35 trillion in wealth through homeownership, many individuals feel less well off due to the difficulties in accessing this wealth. As one expert proposed, perhaps it's time to explore alternative models, such as cooperative or fractionalized ownership backed by government, to make it easier for households to unlock their equity without being forced into debt or other financial constraints. Now, I know some of you might be thinking, But Louis, isn't homeownership the American dream? And yes, it is. However, it's crucial to acknowledge that this dream can be complicated by factors like market fluctuations, economic downturns, and changing interest rates. As we've seen time and again, even the most well-intentioned plans can go awry when unexpected events occur. As we navigate these complex issues, it's essential to remain informed, adaptable, and aware of the potential risks and opportunities on the horizon. Whether you're a seasoned investor or just starting out, understanding the intricacies of the housing market and mortgage lending landscape can help you make more informed decisions about your financial future. Stay tuned for our final story of the day, right here on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're glad you're still with us as we dive into the latest developments in the world of finance and economics. Today, we've been exploring the impact of trade tensions on global markets, and now it's time to take a closer look at how these tensions are affecting mortgage rates. As we've seen, the ongoing trade disputes between the U.S. and other countries have led to increased economic uncertainty, which in turn has caused bond traders to reevaluate their expectations for interest rates. This has resulted in a downtrend in mortgage rates over the past year and a half, with little sign of this trend being broken anytime soon. However, for mortgage shoppers, this uncertainty presents a difficult decision, whether to opt for the certainty of fixed rates or take a gamble on variable rates. With Trump's tariffs creating economic chaos and insecurity, paying extra to gamble on rates is becoming less appealing to borrowers. Despite the market expecting 2 more Bank of Canada rate cuts this year, many are choosing to play it safe and lock in fixed rates near 4%. We've also seen some movement in insured 1-year fixed rates, with Innovation Credit Union cutting its rate by 15 basis points. However, for the most part, mortgage rate leaders have remained steady this week. As we consider these developments, it's essential to remember that economic conditions can change rapidly. While it may be tempting to take a chance on variable rates, it's crucial to weigh the potential benefits against the risks. As Robert McClister, a mortgage strategist and interest rate analyst, notes, paying extra to gamble on rates is appealing to fewer and fewer borrowers. In conclusion, the current mortgage landscape presents a complex array of options and trade-offs. As investors and mortgage shoppers, it's essential to stay informed and adapt to changing economic conditions. By doing so, we can make more informed decisions and navigate the risks and opportunities in the market. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe. And until next time, invest with caution.